Good morning, matriculants, and welcome to our second session of revision. Today we will be looking at the telematics microeconomics revision for 2020. However, I must just at this point tell you that I'm not doing everything in microeconomics. We'll only be looking at perfect markets and imperfect markets in detail this morning, and I will touch on market failures because at this stage I'm not sure how many of you have managed to cover that section of work yet. So we'll get going. Okay, the first thing I'm going to start off are with some of the concepts that I find where learners easily confuse the concepts, and then I just want us to just quickly run through those concepts quickly. So the first one that I've come across is that people get confused between the concepts external cost and social cost. You need to understand that when we talk about an external cost, that is a cost to a third party arising from the production or consumption of a good or service. Okay, so this is when you having to pay for something which you did not have any you're not getting any money for it, you're not involved in the production thereof, you could perhaps be involved in the consumption thereof, but this is when you'd have to pay either for a doctor because your chest has been compromised or whatever. Whereas your social cost, on the other hand, these are negative outcomes of production or consumption of a product, and it is something that affects society as a whole. It doesn't affect a particular person or a particular area. It is society as a whole. And a good example there would be obviously like we have pollution. If you think of the cars out on the roads causing pollution, entire society is affected by that negative outcome of pollution. Then the terms independence and interdependence. Right, independence is when a business owner makes decisions without needing to consider actions or reactions of others. They act entirely on their own by themselves without considering anybody else. Whereas with interdependence, the word inter meaning we are dependent on one another. Okay, so where businesses take into account the likely reactions of their rival to any change in price output or forms of non-price competition. So if you look at the difference between these two, if you look at independence, that would be where, like for example, a monopoly. He is a sole owner or sole producer within the market, so he'll make all his decisions without considering how it's going to affect anybody else because he's got no competitors to think of or to consider. Whereas within an oligopoly market, we have what we call the interdependence, where the decisions made by one has some effect on their competitors. So before they take a decision, they've got to decide how are their competitors going to be what impact will their decision have on the competitor. So that is the difference between interdependence and independence. So if you think of independence more within a monopoly market structure, whereas interdependence is more within your oligopoly market structure. Right, then the difference between revenue and profit. Revenue is the money that you receive from what you have sold. So that's your income from sales. So it's the money that you receive from all the goods sold. But the goods sold doesn't necessarily represent your profit. So your profit, on the other hand, is when that revenue that you've earned from the sales is greater than the cost of your production or the cost of acquiring the goods. So when your revenue exceeds your cost, that gives you your profit. So once again, revenue is just looking at money received from sales, whereas profit is the difference between the revenue and the cost. Then we have another two concepts, average revenue and marginal revenue. Now, as the term says, the average, so that is when we take the total revenue that we've earned and we divide it by the number of units that were sold. So in other words, your average revenue will also give you your price per unit. So if I'm selling goods at 10 Rand each and I made 100 Rand, so I take my 100 divided by 10, which will give me 10 Rand per unit. So that means my price of my product is 10 Rand per unit. Right, whereas marginal revenue, on the other hand, this is the increase in revenue resulting from an additional unit of output. What's important to remember here is that you also need to bear in mind what are the formulas for calculating these, right? That's also very important and quite useful. So if you think of the calculation of average revenue, that would be your total revenue divided by the number of units sold. Right? Whereas your marginal revenue, on the other hand, again, the formula for your marginal revenue would be your, once again, you'd start with your change in total revenue divided by your change in quantity or output or units sold. Okay, so that is the formulae that you will use for calculating those, right? But just important, your average revenue is the same as your price per unit, whereas your marginal revenue is the increase in revenue from the last unit that was sold. Right, the difference between a cartel and price leadership. Now, please bear in mind that both of these, your cartel and your price leadership, they are examples of the kinds of collusion that exists within an oligopoly market structure. So a cartel is when there's a formal agreement that is entered into by producers regarding either their output or their pricing, but what you need to understand is that they've come together and they've actually now signed a contract or made a formalized agreement as to this is what we're going to do with regards to the output or the pricing of our goods, etc. And please bear in mind, this is the collusion that is not accepted in South Africa, right? And then your price leadership, on the other hand, is where within a market structure, the dominant firm takes the lead with regard to price setting, and then the others will follow. You will always see this with your cell phone service providers. As soon as the one firm starts dropping their prices, price rates or whatever, you will see the others will then also follow and do the same, right? So these are situations that we find particularly within the oligopoly market structure. Right, sunk costs and fixed costs. Sunk costs, any cost that cannot be recovered if a business decides to leave an industry. Whereas fixed costs, on the other hand, this is a cost that does not vary directly with the level of output. So irrespective of what your level of output is, whether you're producing 1 unit or 100 units, your fixed costs will always be the same. And the most common example that people use is rent, and they forget about things like insurance, for example, is another example of a fixed cost, because your insurance that you paid is fixed, particularly if you think of your short-term insurance. So if you take out insurance on your vehicles, that will be a fixed cost that you have to pay. Irrespective of whether you're driving around with a vehicle or not, you're still having to pay the insurance thereon. Your sunk costs, on the other hand, these are costs that you cannot recover if you decide to leave an industry. So monies you've paid out to set up, maybe you had to expand the building you were renting, or you had to make some improvements. Sometimes you cannot recover all of those costs, okay? Then the efficiency, allocative and productive efficiency. Allocative efficiency refers to the value that the consumers place on a good, and that value is equal to the cost of the resources that are used up in the production process. Whereas your productive efficiency deals with the business itself. So this happens when a business reaches the lowest point of its average cost curve. Then it's being productively efficient. So they're making the full use of their factors of production, or they're using it in the most effective way. Whereas allocative efficiency, on the other hand, deals with when you are meeting the needs of the consumer, on the other hand. Then another concept that causes quite a bit of confusion is the difference between the short run versus the long run. And the only thing you need to remember here, grade 12s, is that in the short run, you have one factor of production that is variable, and in most cases, it is the factor of labor that becomes the variable, because it is much easier to change your labor input than it is to change anything else really within a short space of time. Whereas with the long run, that is when all factors are variable, right? There are no fixed factors within the long run. All your factors of production becomes a variable. Then the other term also that causes confusion is short run and short term. Right? When we speak about the short term, this is when we're talking about a period of time. So in accounting, when we speak about short term, we're talking about 3 months, 6 months. It's the time period we're talking about. In economics, we're not specifically referring to a time period, so we talk about the short run or the long run, meaning over a short period of time or a long period of time, but it doesn't have a particular number attached to it. So you just need to remember that. Okay. Right. So now we're going to move on to the perfect market and look at the type of exam questions you can expect to see. Okay, so number 1 says, study the following graph and answer the questions that follow. Very popular. They love to ask this. And please make sure that when you look at a graph, you understand what you are looking at and that you are okay with what you are looking at. So by me looking at this graph, the first thing I picked up was this MC curve is not in the correct place, but those are one of the questions which we will look at a bit later on. The second thing I've noticed is that if I look at this area that is colored in here, that tells me that this business is making a profit, right? This is giving me the indication that it's a profit. And why do I know that? Because there's my average revenue. And look at where's my cost. It's right at the bottom here is the cost. Okay. Right. So the first question, which market structure is represented in the above graph? And obviously, I said we're doing perfect market, so this would be a perfect market structure. But why do we say so? There it says, give one reason for your answer. And immediately, it is because that curve there is horizontal. Because it's only in the perfect market where we find that the demand curve is horizontal. And why is it that a business within a perfect market, that's another question that could be asked. Why does a business in a perfect market have a horizontal demand curve? And that is something we will see a bit later on too. Okay, you could also say either the demand curve is horizontal, or you could just say D is equal to AR equal to MR, meaning demand is equal to average revenue, it's equal to marginal revenue. Right. Then why is the MC curve incorrect? Remember I said to you at the start, when I looked at this graph, this MC curve I could immediately see as incorrect. The reason it's incorrect because your MC curve should always cut your AC curve where AC is at its lowest. So it should have cut the AC curve here, right? At this point here is where it should have cut the AC curve. So please remember that, because you could also be asked to draw this graph and you must then ensure that your AC goes through that point there. Right. Does this graph represent the short or long term? And give a reason for your answer. Right. So if you look at this here, this business here is making an economic profit, and we know that within, if I remember my characteristics of a perfect market, one of the characteristics is that they make economic profits in the short run, not in the long run. So because this is a graph depicting economic profit, that is how I know that this is now the short run and not the long run. And then question 5, very popular question, you will always be asked this: calculate the profit made by showing all calculations, okay? So 2 ways in which you can calculate this. You can either do it by just simply saying 15 minus 10, 15 being the revenue, 10 being your cost. So 15 minus 10 is 5, and then that 5, this is per, remember this is per unit, so now my units are 50, so I go 5 times 50, so my answer will be 250. The more lengthy answer would be 15 times 50 and get your answer, minus 10 times 50 and you get an answer. So you see here, you got, that's the first one. The second one, 15 times 50 gives me 750. 10 times 50 is 500. So I've got 750 minus 500. I once again get an answer of 250, which is exactly the same answer there. So it's also a means of checking to see if your answer is correct, right? So you can use both ways to work it out, and that's a means of checking the correct answer as well. But you only write 1 in your answer book, right, as your final answer. Right, number 2, once again, we're looking at a graph. Study the graph below and answer the questions that follow. Now here we've got a graph represented in a different way. Here we've got the total cost and the total revenue graphs, which you had done in grade 11, right? So immediately when I look at this graph, I already see what is the information I can gather off this graph. At point C and at point B is where TC equals TR. So that tells me those are 2 break-even points, or also 2 normal profit points. And then this area here, if I look at this area here, I see that is my total revenue running there, and this is my total cost coming here. So my revenue is above my cost. So that's telling me this area A represents my profit area, right? So if I go this side here, my cost is higher than my revenue. If I go after B, once again, my cost is higher than my revenue. So for this business to be profitable, it would be best to produce between 20 and 50 units. Right, let's see the questions that were asked here. How is profit calculated? So to calculate profit, it is your total revenue minus your total cost, okay? Which profit does the firm earn at point B? So if we see here point B, total cost, which profit? So it's total revenue minus total cost, and it's 5 for either one. So 5 minus 5 is 0. So that tells me when it's 0, they're making normal profit, okay? Business studies, we call that the break-even point, okay? Why is the TR curve starting at 0? So we see here, total revenue starts at 0. Well, that is obvious, because if I don't sell anything, then I'm not going to earn anything, right? But you will now turn around and say, but my cost is there. Remember earlier on we spoke about fixed costs that have to be paid irrespective of the number of units produced. So therefore, it's very difficult for that total cost to be at 0. When is profit maximized in the above graph? And we can see here, they want to know when is the most profit being made, because this entire area here represents the profit area. But the question is very specific. They say, when is profit maximized? So you can't just say at point A, because point A stretches this whole area. So the maximization of profit would be at this point here, right? So you've got to be very explicit in your answer. Profit is maximized when the gap between TR and TC is the greatest. Okay, so what we are saying, where area A is at its biggest, right? So we see at that point is where it is much further away from the revenue curve. What are the implications of producing beyond point B? Remember, I said if you look beyond point B, if you're moving over, then your costs are going to be bigger than your revenue, which means you're going to start making a loss now. So beyond point B, total costs are more than total revenue. So producing beyond this point, the firm will suffer a loss. You please bear in mind, you don't have to use the exact words. If you just say something that sort of explains that, that is absolutely fine. Right, once again, we've got a table now, not a graph anymore, but here they're giving us a table, and it says a loss to shut down or not. And then they give us total revenue, fixed costs, variable costs, total costs, and total loss. And then you've got firm A and firm B, right? So they're giving you the revenue of each of them, the cost, the variable cost, total cost, as well as the total loss suffered by each one. The first question, in which run are the two firms operating? They're referring here to, is this the short run or is it the long run? Now, how would I know that? Remember what I said earlier on, the way we can distinguish between short run and long run is that in the short run, you have one particular variable, but in the long run, everything becomes a variable. So you see here, you have fixed costs, which means some variables are fixed. So therefore, I know then I'm dealing with a short run. Give an example of a fixed cost. I said this earlier on, rent as well as insurance. You can give either one. With reasons, identify a firm that will shut down. So if you look at firm A or firm B, which firm would you think would be more likely to shut down? Just by looking at their loss, you can already see that answer, right? Because you can see firm B's losses are way greater than what firm A's losses are, okay? And and you also look here, their variable cost in terms of what they are earning, right? Their variable cost even is higher than their revenue that they're earning. Whereas at least in firm A, you see its variable cost is still lower than the revenue. Right, what do you think are the implications of a shutdown? This is something that causes a great deal of confusion as well. When you speak about a shutdown point, students immediately say, oh no, they're going to close down. The business is going to close down. No, that's not what it means. What it means is maybe they need to temporarily shut down and rework some things, and then they can carry on again. It doesn't mean they're closing their doors and they're never going to operate again. Alternatively, they could perhaps look at shutting down one part of their business. Let's say I run a business where I'm making shoes, handbags, and something else. But I find that the handbag section of my business is not doing that well. So I can decide that section of the business I'm going to shut down, and we're not going to produce handbags any longer, but we will carry on producing whatever else it is we are producing. So when we talk about shutdown, it doesn't mean close the business, we're out of business, and that's it. It just means making decisions as to how we can become more profitable. Right? And in business studies, you do those long-term decisions that businesses have to make, or restructuring decisions that they have to make, where they either sell some of their assets or they shut down a certain part of the business. So that is what we speak about a shutdown, right? A firm stop production for a certain period, it's temporary. It does not mean that a firm is going out of business. It still retains capital assets, but cannot avoid paying its fixed costs, right? Because remember we said these costs have to be paid irrespective of whether you're producing or not. Question 4, study the graph below and answer the questions that follow. Very similar to the graph you saw on top in question 1, but you will see the kinds of questions asked now also differ. So even though you can use exactly the same graph, different questions asked. Okay, the first one, which market structure? That is exactly the same question. Perfect market. And how do we know that it's a perfect market? Because it has a horizontal demand curve. Second question, identify profit maximization point. Right. So the point where the business makes its most profit is where your MC equals your MR. Profit maximization point in any business, whether you are working within a perfect market structure or an imperfect market structure, profit maximization is always at the point where MR equals MC. Now, what I would like you to remember also, another term for profit maximization is the minimum loss that is made, right? So I remember in a past paper they used the term minimum loss and students were completely thrown because they've never heard the concept before. And so I'm just putting it out there for you today that minimum loss is exactly the same as profit maximization, okay? Right. So that is where MC equals MR, and in this case here it is at point A. Briefly describe the demand curve in the graph above. So if I look at the demand curve, as I said earlier on, it is a horizontal demand curve. So when that demand curve is horizontal, again, a concept which we taught to you in grade 11, we can see it is a perfectly elastic demand curve. So you can either say the demand curve is perfectly elastic, or you could also say the demand curve is horizontal. Briefly explain the output level of a perfect competitor, right? Right, so if you look at the output, a firm would prefer to obviously operate at its profit maximization point, right? It will not move beyond this point. Because remember, this is the point where you're making the most profit, right? But if you look here, that space there, so you can still produce up to this. So it's from this point here up to the 100. That area is your profit area. This is making the maximum profit. So you do not want to go to the right of that 100 units, because there you will see now that is when your cost starts going up again. So you're going to be eating into your profit. Okay? The same thing if you're selling less, you're going to be earning less revenue, but your cost is still going to be the same. So you would rather want to be at point A where you are making, right, so they say a perfectly competitive firm can sell any number of units of output at exactly the same price. Remember, they have no control over the price. But they can sell more or less than 100 units at the price of 6 Rand. They would prefer to sell at 100 units because that's where they're making the maximum profit. And then again, the question of calculate the profit or the loss that's being made. And immediately we see here, our revenue is at 6 Rand and our cost is at 4 Rand. So I know I'm making a profit. And the profit that's being made, it is the 6 revenue minus cost. So it's 6 minus 4 is 2, but remember, this is average revenue, this is average cost. And to get average, it is the total divided by the number of units. So to get to total revenue, I've got to say 6 times 100, it's 600 Rand, minus 4 times 100 is 400 Rand. So my profit here is 200 Rand. Alternatively, 6 minus 4 is 2. 2 times 100 is also 200 Rand. Right? So you see there, either TR minus TC or AR minus AC times the units. But the answers are exactly the same. Right, question 5. Study the graph below and answer the questions that follow. So here we've got the industry graph and here we've got the graph of the individual business. So this here illustrates to us how the business derives that horizontal demand curve. Because the business has to accept the price that has been set by the industry. So therefore, their price, the demand is perfectly elastic, meaning the price doesn't change. Okay, the price remains the same. They've got no control over the price, so therefore they are known as price takers. Right, so the first question here, at which price will the individual business sell its product? Obviously, at whatever the market equilibrium is, which is the 3 Rand. How is the slope of the demand curve of the industry? We've had this in the question before this. The slope of the curve, it is a horizontal demand curve. The slope of the industry. So we're looking at this demand curve here. So we see there it runs from your top left to your bottom right. So it has a negative gradient, right? So therefore, your industry curve has a negative slope. Briefly explain the phrase, businesses are price takers, as I just said to you earlier on. The business is a price taker because they are not involved in the setting the price. The price is set by the industry and the business has to accept the price that has been set by the industry. How are prices determined in the industry? Obviously, as you can see here, it is determined where demand and supply meets. Okay, so at that point there. In your answer book, redraw the graph of an individual business and insert curves that show the business making economic profit. Now remember, I said to you earlier on, you're going to have to sometimes draw this graph, and there they've asked you now. So you redraw that graph, and then you have to insert now your AC and your MC curve. But please remember, when you are doing your AC and your MC, make sure that MC cuts your AC where AC is at its lowest, right? Please ensure that. Okay, sometimes students say, but I don't know where to start, so I'm just going to quickly show you that. So I have to redraw the business. So remember, I have to draw it exactly as I'm seeing it there. And then they've got DD equals AR equals MR. And then this is quantity. And price or revenue. Right. Then, and this is 3 Rand here. Then I have to now include the curves. So I'm going to put in my AC curve, and I find it easier for me to first draw my AC curve. Right? Looks like a smile. And then I can ensure that my MC cuts AC where AC is at its lowest. Okay? So those are the curves that I have to now put in as well in order to, so if you see there, and then you will be given the marks according to the curves that you are asked to draw in. Okay. Right. Right, so that brings us to the end of your section B type questions that you could be asked in terms of perfect markets. I hope you've seen now that you either get a table or you get different graphs, and then there are question set. Those are the kinds of questions you can expect in section B. We are now going to have a look at your longer answers or your 8 markers, which is more, some of your 8 markers are out of the box, meaning these are not things that's from the textbook or in your notes. And then you also have your 8 markers, which is directly from your notes. Right, let's have a look at that. Question 6, explain free competition and nature of the product as characteristics of perfect market. So what they're doing here is you're looking at 2 of the characteristics, the first one being free competition and the second one being the nature of the product. Now, when you are faced, and this would be an 8-mark question, so when you are faced with a question like this, where you are asked to explain 2 different items, right? The first concept you're looking at is the free competition. So you need to get at least 4 marks for that one and 4 marks for the second one in order to gain the full 8 marks. If you are only going to write on free competition and nothing, you're only going to get half the marks, okay? So please bear in mind, the marks are divided 4 and 4. So if you think of free competition, that means that the buyers must be free to buy whatever they want from any firm in any quantity, as well as the sellers must be free to sell what, how much, and where they wish. Okay? And the main thing behind free competition is that there should be no state interference and no price control. And then there they also speak about buyers should not form groups, nor should sellers should not combine to enforce higher prices either. So there's 1, 2, 3, 4, 5 points given. You only need to give 2 of the 5 for free competition, and you only need to give 2 of the 3 under nature of the product, right? So when you look at the nature of the product within a perfect market, they are called homogeneous, right? The products are called homogeneous products, and what homogeneous means is they are exactly the same in quality and appearance, okay? So if you say to me all products sold in the market are homogeneous, they are exactly, this is not 2 separate marks. That is one, because all you're doing here in the second point, you're explaining to me what is the meaning of homogeneous, okay? Whereas the third point, it makes no difference to a buyer where or from whom he or she buys the product, okay? Because remember, they are exactly the same. Then if you look at question 7, they ask you the same question again, explain the nature of the product, but now they're not asking, now they're asking you market entry again with that. So once again, same description for nature of the product, but now you're looking at another characteristic, which is market entry. So what I'm trying to show you here is that they can ask you to discuss any of the characteristics. So it is important that you know all the characteristics of the free of the perfect competition, because you don't know which ones are going to be asked. Here they asked free competition and the nature of the product. Then at another time they ask nature of the product and they ask market entry. But they could ask you to write about the profits within the perfect market or any of those other characteristics that are there. Right, so if you look at market entry within the perfect market, there are no barriers to entry. So there is nothing that stops new business entering the market. There is complete freedom to entry and exit. Sunk costs are low. Remember, we spoke about sunk costs earlier on. What are sunk costs? Money invested in a business that cannot be recovered if the business closed down. Entry is not subjected to any kind of restriction in the form of legal, financial, technological, or other barriers. And there is less capital required to enter this market. Right, number 8. How will new entrants in the perfect competitive market impact on the profit level of existing businesses? So, the way in which new entrants will impact, obviously, one of the things here, they said here, is that there is complete freedom to entry. There are no barriers that stop new businesses. So this kind of thing happens quite easily. Okay, so if you can think of this logically, so there are now 100 producers in the market and 2, 3, 4 more people come in as well. So immediately, those existing producers or existing sellers within the market, they are going to lose what we call market share, meaning some of the consumers will now go to the new suppliers and support them. So which means those businesses that are already in existence, they're going to lose out on sales. They're going to lose out on revenue, and if they're losing revenue, that means their profit is going to be decreased. So the first one is going to be that the profits will be decreased. Okay? Also, secondly, with more people coming into the market, meaning there are more suppliers. So I just need us to look at that one quickly. If you remember your industry graph, right. So what's going to happen is, with new people coming into the market, the supply curve is shifted. So with the result, this was the original equilibrium point, market equilibrium. So let's say it was 10 Rand a unit at that point. But now with the shift of the supply curve, we're going to get a new equilibrium formed at E1. And now you're only getting 8 Rand a unit, right? So I'm losing market share, first of all, because other customers are going to the new suppliers, so that impacts my profit. Then the second thing is the price at which I can sell my product is also getting less. So that also impacts not only on my profit, but also on my costs, because for some businesses, what that can mean is that because of that drop in their revenue, in what they can sell it for, means that now instead of making an economic profit, they now are only making a normal profit, which is the minimum at which a business can operate within the perfect market. For some, it might mean that they are now operating at a loss, and if they can't sustain that loss or turn around in time, it means they're going to have to leave the market. And this is the sort of vicious cycle you find yourself in perfect markets, is as more move in, some move out. So the ones that are left over now start making economic profit again, and it is that economic profit that attracts others into the market. And that is the vicious cycle you see happening all the time. As soon as the one leaves, the other one enters. Now those that are in the market start making economic profit again. So other suppliers see, oh, I also want a piece of the action, and then they move in, and then the existing suppliers start losing profits and start losing money. So some of them have to leave the market, and that's how it carries on all the time. Okay, so if you go back to the answers here, new firms enter the market when existing businesses make economic profits in order to benefit from the profits. This increases the market supply. The increase leads to lower price levels of goods and services, which I've shown you with the graph. So this causes smaller or lower profit than previously. I've explained that to you. Production increases until some businesses cannot cover their average variable cost anymore, causing the shutdown and exit the market. And only normal profits are realized in the long run. Okay? Right. Question 9. With the aid of a graph, illustrate the long-run equilibrium of the individual producer in a perfect market. We just said now in point number 8, only normal profits are realized in the long run. So now the next question is asking you to illustrate the long-run equilibrium of the individual producer in a perfect market. So you need to draw a graph that represents normal profits. And then there's your graph. Your AC curve is now tangential to your AR curve, right? It is sits on top of your AR curve. Okay, that is the kind of question that's straight from your notes. You know how to draw that. This is the kind of question that we call out of the box type of question. Okay, then the last section we're going to look at in perfect markets is your essays within this section, obviously. So the first essay that we're dealing with here, essay number 1, with the aid of graphs, explain the following about an individual business under conditions of perfect competition. The effect on price if the individual producer increases or decreases his output. And then the second part of the question, of the body, the derivation of the supply curve from cost curves for the individual producer. Before we look at the answer to the question, I must just warn you, I have not included the 10 marker, because your 26 marks of your essay and your introduction and your conclusion, that you can prepare ahead of time. But 10 markers change all the time. So anything can be asked as a 10 marker. However, I must just give you one thing that I've noticed when it comes to perfect markets, and the 10 marker always deals with something to do with a competition policy, right? That they always ask something in line with that as the 10 marker. Right, so they said, with the aid of graphs. So that tells me I have to show graphs, right? And please notice 6 marks has been allocated for the graph. So which graph am I showing? Because they say here, the effect on price of if the individual producer increases or decreases his output. So here we see the individual business, original supply curve, right? S1 is him increasing the supply. S2 is where he is decreasing his supply, right? So let's see. We start off by explaining why that's a straight line, the demand curve. That P there should have been a D and not a P, okay? Please take note of that. So the demand curve is a horizontal line because he's a price taker. So if the individual producer increases its supply, so the supply, if he increases, we will move from S to S1, okay? So what are we doing here? We are saying here exactly what has been drawn there. That is the one thing you must remember, okay? So at this point, the equilibrium quantity increases from Q to Q1. But the price is still the same at P1, okay? So even though I'm supplying more, I can't sell for more, so my revenue is increasing because I'm selling more than I have at Q. Right, what if it decreases the supply? So what we see is, then we see the supply curve moves from S to S2, and the quantity moves from Q to Q2. But has anything happened to the price? Nope, the price is still the same at P1. So to answer that first question here, the effect on price if the individual producer increases or decreases his output, what can we see from this graph? That whether he shifts it to S1 or whether he shifts it to S2, the price still remains constant. Please, grade 12s, one thing I've noticed, students are very good at drawing the graph. They can draw the graph perfectly, but when you ask them to explain, then there's nothing. It is not rocket science, people. You just have to write down what you have done on the graph. So you say, the supply curve has moved from S to S1. The quantity has moved from Q to Q1. And that was an increase in supply. Price hasn't changed. Price is still at P1. You must write in words what we are looking at on the graph. Okay? Always remember you are trying to explain this graph to a person who knows nothing about graphs. Right? So they must be able to look at the graph, read your explanation, and understand what is happening there. Okay. Right. Then the second half of the question speaks about the derivation of the supply curve from cost curves for the individual producer. Right. So if we look at that now we're looking at the cost curves, and now we've included your marginal cost as well as your average cost as well as your average variable cost. Okay. Right. Okay, so we're trying to see now how much does this person have to produce. So the individual supply is derived by taking different market prices and determining how much the business should produce at each price. So the individual firm maximizes profit. What did we say earlier on? Where MC equals MR. Okay, so if you look at point B is where he is maximizing his profit, because that's where MC is equal to MR. Okay, so provided that the average income is enough to cover the average variable cost. So we see there his average income is at P3 and his average variable cost is at P2. Okay. Average variable cost comprises costs like labor, material, fuel, electricity, etc. So under perfect conditions, the producer will produce where P is equal to MR is equal to, so that point there, right? That's where you will produce, which gives you Q3. Okay? Thus, we derive that the supply curve of the firm is the section of the MC curve above the intersection with AVC. So from point A upwards, that is your supply curve, right? That is where you will start from Q2, Q3, Q4. Those are the positions where they will be producing. Right, so if we look further at the various price levels, at P2, if you look at P2, your AR is equal to your AV, and that point A there is also known as your shutdown point. That is because they are only able, because you see there's AVC, look where's AC. Now remember, AC is AVC plus AFC, fixed cost plus variable cost. So they can only cover their variable costs. They are unable to cover their fixed costs. So therefore they need to look at shutdown or making some decisions. At P3, there we see they're making a normal profit, no loss, because your AC is tangential to your AR. And then at P4, right, price level 4, if they're selling there, then that means their revenue is going to be greater than the AC, so that's where they'll be making economic profit. Right, so that is the explanation for that one, and that is, like I said, only your body of your essay that I've given the answer for. With this essay, your introduction would obviously be, you can either explain what a perfect market is, that would be as way of introduction, and then your conclusion could be anything that was not mentioned before can be mentioned within a conclusion. But remember, your conclusion isn't as straightforward as an introduction. Conclusion needs to be a bit more higher order. Okay. Right, question number 2. Explain with the aid of 3 separate graphs the following short-run equilibrium positions in a perfect market: economic profit, economic loss, and normal profit. Please note they have given you the maximum amount of marks for each one. So even if you write a whole essay just on economic profit, you're only going to get 10 marks. But once again, with the aid of 3 separate graphs. Now remember, the graphs are also given marks. And here the maximum given for graph is 4. So if I look here for economic profit, they wanted 10 marks. So 4 marks for just the drawing of the graph, and then 6 marks obviously for the explanation. Now please bear in mind once again, The explanation is not separate from the graph. You are explaining what is happening on the graph. Okay? It's not a separate item. So you're just saying what is happening. So if I have to discuss economic profit, I will obviously first discuss what is my revenue, because to get to profit, it is total revenue minus total cost. So total revenue would be the 50 times 10, which is 500. My total cost would be 40 times 10, which is 400. So the profit that I'm making will be 100. Okay? So those are the 2 points that they discuss. The 3 points that's being discussed there. Okay? And any additional things you want to talk about, but it's not necessary. If you just discussed how to derive total revenue, how to derive total cost, and what the profit is, then that's your 6 marks, and the 4 marks for your graph is already giving you your 10 marks. The same thing when you're discussing economic loss. Once again, you're drawing the graph, you're talking a maximum of 4 marks. Please note, this is the one where students also get it wrong. Your output is where your equilibrium point is. And it is from that point that you draw the line up to the AC curve and across to get your cost. Okay? It is not where AC meets MC. It is from your equilibrium point up to the cost curve and across. Right? So once again, my total revenue is 40 times 10, which is 400. My total cost is 50 times 10, which is 500. And 400 minus 500 gives me an answer of minus 100, indicating the loss being made here. And then the last one is they want you to show the normal profit. Again, 4 marks, and then 6 for the explanation. Okay? So again, you will start by explaining where MR equals MC. That's profit maximization. So that is where they will be producing. And then you can say the revenue is 50 times 10, which is 500. The cost is 50 times 10, which is 500. So the profit is 500 minus 500, which is 0. And then you can explain that that's the minimum that a business should be earning before leaving the market. Okay. Right. That's the other essay question which you could be asked is obviously to discuss the characteristics of a perfect market. But remember, with the 8 markers, I said you still need to know those characteristics, because it can either be as a 26 marker or talking about the various characteristics, or 2 of the characteristics at least, for a total of 8 marks. Okay, we're going to take a short break quickly before we move on to imperfect markets. Thank you.